Hi friends, welcome to my channel Info Craze. In today's video, we're diving into the basics of accounting, which are very important for students in the field of finance and accounts. By the end of this video, you'll have a fair idea on the accounting processes, which will be very helpful for you. Before we proceed, please do not forget to show your support by hitting that like button and subscribing to my channel for more informative content like this. Now, let's get into the world of accounting together. Let's start with the basic question. What is financial accounting? Financial accounting is a branch of accounting that focuses on the recording, summarizing, and reporting of financial transactions of a business entity to external users, such as investors, creditors, regulators, and government agencies. The primary objective of financial accounting is to provide accurate and relevant financial information about the financial position, performance, and cash flows of the business to facilitate decision-making by external stakeholders. Next, let's discuss the types of accounts in financial accounting. In financial accounting, every debit or credit transaction entry will belong to one of the three types of accounts: personal account, nominal account, and real account. A personal account is a general ledger that relates natural persons or individuals, artificial persons or organizations, and representative personal accounts, which represents the accounts of natural or artificial entities. Some examples of personal accounts are customers, vendors, salary accounts of employees, drawings and capital accounts of owners, etc. A nominal account is a general ledger that is used to record transactions of a business related to expenses, incomes, profits, and losses. These accounts are related to the income statement, which summarizes a company's financial performance over a specific period. It contains all the transactions that occur within one fiscal year. Further, it resets to zero from the start of next fiscal year. Examples of nominal accounts are commission received, salary account, rent account, sales revenue, interest account, etc. Like the other two accounts, a real account is also a general ledger, but it contains transactions related to the assets, liabilities, and owner's equity of a company. Unlike nominal accounts, real accounts are not closed at the end of an accounting period and their balances are carried forward to the next period. The assets, in this case, can be further subdivided into tangible and intangible assets. Examples of real account are cash, bank, inventory, accounts payable, owner's capital, etc. Let's study the golden rules of accounting. These are the fundamental principles that guide the recording of transactions in accounting. These rules apply to different types of accounts, that is, real accounts, nominal accounts, and personal accounts. Here are the golden rules for each. First rule is for the real accounts, which says, debit what comes in, credit what goes out. This rule means that increases in real assets are recorded as debits, while decreases are recorded as credits. For example, when purchasing inventory, which is an asset, it is debited because it increases, and when selling inventory, it is credited because it decreases. Next rule is for personal accounts, which says, debit the receiver, credit the giver. This rule applies to transactions involving individuals, firms, or groups. When a transaction involves receiving something, it is recorded as a debit, and when it involves giving something, it is recorded as a credit. For example, when cash is received from a customer, cash, which is an asset, is debited, and accounts receivable, a personal account, is credited. The last rule is for nominal accounts, which says, debit all expenses and losses, credit all incomes and gains. This rule applies to transactions involving expenses, revenues, incomes, gains, and losses. Expenses and losses are recorded as debits because they decrease the net income, while incomes and gains are recorded as credits because they increase the net income. For example, when paying rent, which is an expense, rent expense, a nominal account, is debited, and when earning revenue from sales, sales revenue, a nominal account, is credited. These rules ensure that every transaction is recorded accurately and consistently, following the principles of double entry accounting. Now, let's go through the accounting process. There are 7 broad steps in the accounting process. The accounting process begins with source documents, which are the original records of financial transactions. These documents provide evidence of business activities and include invoices, receipts, purchase orders, sales orders, bank statements, payroll records, etc. Once source documents are collected, the next step is to record the transactions in the accounting journal. The journal serves as a chronological record of all transactions, organized by date. Each transaction is recorded using double-entry bookkeeping, which means that every debit entry must have a corresponding credit entry to maintain the accounting equation, that is, assets equals liabilities equity. After transactions are recorded in the journal, they are transferred to the general ledger accounts. The ledger contains individual accounts for each type of asset, liability, equity, revenue, and expense. Posting involves transferring the debits and credits from the journal entries to the appropriate ledger accounts, ensuring that each account reflects the cumulative effect of all related transactions. Once all transactions have been posted to the ledger, a trial balance is prepared. The trial balance is a statement which lists all the accounts and their respective balances, debit or credit, at a specific point in time. The purpose of the trial balance is to ensure that the total debits equal the total credits, verifying the accuracy of the recording and posting process. After preparing the trial balance, adjusting entries are made to update certain accounts to reflect accruals, deferrals, depreciation, and other adjustments necessary for accurate financial reporting. These adjustments ensure that revenues and expenses are recognized in the correct accounting period and that the financial statements reflect the true financial position and performance of the business. Following the adjustment process, an adjusted trial balance is prepared to incorporate the effects of adjusting entries. The adjusted trial balance serves as the basis for preparing the financial statements. Finally, based on the adjusted trial balance, financial statements are prepared. The primary financial statements include income statement or the profit and loss statement, which summarizes the revenues and expenses of the business over a specific period, resulting in net income or net loss. Second is balance sheet, which presents the financial position of the business at a specific point in time, showing assets, liabilities, and equity. Third is the statement of cash flows, which reports the cash inflows and cash outflows from operating, investing, and financing activities during a specific period. Next is the statement of changes in equity. This statement shows the changes in equity accounts, including contributions, distributions, net income, and other comprehensive income. These financial statements provide valuable information to stakeholders about the financial performance, position, and cash flow of the business, enabling informed decision-making and financial analysis. In order to have a clear understanding on this subject, let's discuss about the 5 elements of financial statements, which are also known as the basic elements or fundamental elements. In accounting, there are 5 fundamental elements that form the basis of financial statements. Entire accounting is based on these 5 elements, which are assets. These are the resources owned by a company that have economic value and are expected to provide future benefits. Examples include cash, inventory, property, plant, and equipment. Next is liabilities. These represent the debts or obligations that a company owes to others. Liabilities can include loans, accounts payable, and accrued expenses. Next one is equity, which is also known as owner's equity or shareholders' equity. This represents the ownership interest in a company. It reflects the residual interest in the assets of the entity after deducting liabilities. Equity includes items such as common stock, retained earnings, and additional paid-in capital. Next is income. Income, also referred to as revenues or sales, represents the inflow of economic benefits resulting from the ordinary operating activities of a business. It includes revenue from sales of goods or services, interest income, rental income, and other sources of income. Last one is expenses, which represent the outflow of economic benefits incurred in generating revenue. Expenses are incurred to operate the business and include costs such as wages, rent, utilities, depreciation, and taxes. Assets, liabilities, and equity are shown in the balance sheet, whereas income and expenses are shown in the profit and loss statement. These 5 elements are interconnected and form the foundation for preparing financial statements, such as the balance sheet, income statement, and statement of cash flows. With these, we come to an end of this video. If you find this video useful, please like and share the same with your friends. Also, subscribe to my channel for many more interesting videos in the field of finance and accounts. You can also check my videos on interview questions and answers for accountant jobs. Thanks.